Here Wall Street Willie, how are options traded? Like stocks, most options are traded on an exchange, but there are some private options that are traded over the counter. Each options contract is usually for 100 shares of the underlying stock, although multiple contracts can be bought and sold in one transaction. The contract duration could range from 30 days to a year. The further the expiration date, the higher is the option premium, since the possibility of the option becoming profitable for the buyer is greater. Although options can be used to buy or sell the underlying stocks, they are more often used in options trading, where people buy options and sell them to someone else at a higher price without ever exercising the option. Options trading is much more complex than other types of investing, such as trading stocks. Although individuals like you and me can trade options, the vast majority of trading is done by institutional investors, broker-dealers, and market makers who increase option liquidity. What are options used for? Options can be used for a variety of purposes, the most common being hedging, speculation, and profits from trading. Hedging involves using options to decrease a portfolio's risk. For instance, if you own stock in a certain company but are worried the price will fall significantly in the short term, you can buy a put option. This way, if the price falls, you can exercise the put option to sell the stock at a strike price higher than the current market value. On the other hand, if the price increases, you can sell your stock in the market and only lose the premium you paid for the put option. Speculation involves using options to increase leverage so gains are amplified. If you had $100 to invest and the price of a stock is $10, you can only buy 10 shares of that stock. Instead, if you choose to invest in options, you will only need to pay the premium, say around $1 per share, giving you exposure to 100 shares, which is 10 times more than buying the stock outright. Lastly, some people simply want to trade options for a profit by attempting to sell them for a higher price than they bought them for. Very few options trades are made with the intent to actually exercise the option. How do I make money from options? An options contract is profitable, also called in the money, or unprofitable, also called out of the money, based on how the underlying asset's price moves with respect to the strike price. A call option is in the money when the underlying stock's market price is above the strike price. A put option is in the money when the underlying stock's market price is below the strike price. In both cases, the option buyer can exercise the option for a profit. Similarly, a call option is out of the money when the underlying stock's market price is below the strike price, and a put option is out of the money when the underlying stock's market price is above the strike price. In both cases, the option buyer should not exercise the option and instead let it expire. The option seller makes money only when the call or put options are out of the money. Their profit is the option premium. Thank you very much, Wall Street Willie. You're welcome, Super Cooper. Remember, finance is your friend.